Thank you for joining this session. Let's learn income under the head house property in just 5 minutes. There are 3 types of properties. Let out property. Even if you let it out for 1 day, it is considered as a let out property. Self-occupied property. That means it has never been let out, or the let out period is 0 days. Deemed let out. When you have more than one self-occupied property. For example, in the picture, there are 6 properties that you can count. Assuming all of them are self-occupied, you can choose only one as self-occupied. The others are considered as let out, and hence the words deemed let out. Let's understand the calculation now. On the left is the format for calculation under the head house property. We start with something known as the gross annual value. From that, we deduct the municipal taxes. Special note about the municipal taxes on the right side of the page. The municipal tax is allowed only if it is paid by the owner during the previous year. It can be claimed only for a let out and a deemed let out property. It is not allowed for a self-occupied property. From the gross annual value, if you reduce the municipal tax, you get the net annual value. From that, you are eligible for 2 deductions under section 24. 30% standard deduction. This is calculated on the net annual value. And the second deduction is interest on loan. The final result is known as income from house property. The GAV calculation has 3 steps. Step 1 is calculating the higher of municipal valuation or the rent of a similar house. Step 2 would be comparing this value in step 1 with standard rent fixed by the Rent Control Act. The amount that we have arrived at in step 2, being the lower of the step 1 value of the standard rent, is known as fair rent or FR in short. Step 3, we calculate the actual rent. While calculating the actual rent, you should take the rent received plus receivable. It is done on an accrual basis. Unrealized rent, that means rent for the period for which the tenant has not paid the money, will also be included. Unrealized rent may be reduced from actual rent if Rule 4 conditions are satisfied. Unrealized rent may not be reduced in any other scenario. Remember, never include the vacancy period rent, that is the rent for the period for which the house was kept vacant. The GAV of a self-occupied is 0 and the GAV of a deemed let out is the FR. Once we have decided the AR and the FR, we have to compare the two. If the AR is greater than FR, then the GAV is AR. If the AR is lesser than FR, if it is due to vacancy, then we would choose the AR as the GAV. If it is due to any other reasons, the GAV would be the FR. Interest on loan can be given for both let out, deemed let out, up to unlimited amount. There is no upper limit, and it can be given for any purpose. There are 5 purposes which you may borrow the loan for: construction, acquisition, repairs, renovation and reconstruction. There is no upper limit and the loan could have been taken for any of these purposes. For a self-occupied property, the maximum limit of interest is 2 lakh. If the 3 conditions given are satisfied, the loan was borrowed on or after 1/4/1999, the construction or acquisition was completed within 5 years from the end of the financial year in which the loan was taken, and interest certificate is issued. Otherwise, in any other scenario, the maximum interest which can be claimed is 30,000 rupees. There is a concept of pre-construction period interest, that is the interest for the period before which the house property was fully constructed. This is given in 5 equal installments starting from the year of completion of construction. The pre-construction period starts on the date of the start of the construction and ends on the 31st March of the year preceding the year of construction. Remember one important tip, the pre-construction period always ends on 31st March, but the start date could be any date.